Good morning and welcome this morning to Advanced Charting Techniques, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And I have the opportunity to sit in for Cameron May on this particular webcast today. So I appreciate the chance to come in and spend a little bit of time talking a little bit about one of my favorite subjects, technical analysis. We're going to talk about advanced charting techniques and explore some of the extremes today. That's kind of the thought process that I had in building the discussion for today's webcast. I'm joined out there by someone who screams extreme, Barb Armstrong. She's an extreme Canadian. She's a great educator, and she's a good friend, and she's out there in the chat to help out answering your questions. So be a part of the conversation. For all of those of you who are here in the live session, go ahead and be a part of the chat and send some questions in. If you are watching in the recorded version, please leave us a comment in the comment section, and we will get back to you as quickly as possible in that discussion as well. So we're grateful that you are here. Regardless, a couple of quick housekeeping items as we get started today. Remember that everything that we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or chart type or anything else. If we do happen to talk about options either on a specific basis or on a casual basis, remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember also that technical analysis is only one way to evaluate the market. Probability analysis, fundamental analysis, all of those are methods as well. All of them, including technical analysis, are theoretical in nature. None of those are guarantees as to what the market is going to do. And therefore, Schwab doesn't recommend the use of technical analysis or really any other method of analysis as a sole means of investment research. So combine some of those and put something together. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. And it's a great learning environment. It is a great sandbox to play and practice in, but it is not a guarantee of future success out there in the real world. Also, remember, there are certain things that the paper money platform will not do that a live trading account will do or may do. And so be aware of that as you move your practice from paper trading to live money, that some things change. One of the things that's specific that we're going to talk about today is the fact that in a paper money account, if you are using studies or trying to use studies in a scan or a search in the paper money account, it will not let you do that. So you have to do that. You have to use those scans that includes studies like the one that we're going to look at today in a live trading account. Now, I'm going to be demonstrating using my demonstration account, which is a paper money account, I assure you, but it is built to look like a live and act like a live trading account. It is not a live trading account. These are not illustrated. These are not live examples in the sense that they are being traded on live money simply for illustrative and educational purposes only. Remember that there is no guarantee of future success out there in the market. So we're going to talk about how we might implement a technical study. We're going to talk about the pros and cons of a particular technical study, and we're going to look at examples on the charts. So I want to do this without much preamble other than the idea of extremes, is I want to pop out to the Thinkorswim desktop software platform, and I want to take a look at an individual stock here that has had an extreme move. That extreme move kind of significant here. Now, while you're out here on the Thinkorswim platform, while we're looking at this particular chart, you notice down at the bottom of the page, there's that little subscribe button. This is a good reminder for me to ask you and suggest to you to subscribe to our Trader Talks webcast channel if you have not done so already. And Jennifer asks a great question. How do you access the paper money account in the Thinkorswim platform? When you go to the login splash screen, you have that toggle down at the bottom that lets you toggle between paper money and live. If you're in the web-based version, that toggle is in the upper left-hand corner. If you are in the mobile version, the toggle is on the login screen. So that's where you're going to find those toggles between paper money and live trading so that you can jump into that. And by the way, if it's paper money account, and you're in your paper money account, all of these things that are in blue here, like schwab.com and the home screen and things like that, all of those are going to be kind of a yellowish gold color to remind you that you're in paper money. But speaking of extremes, What do you happen to notice about this particular stock? I mean, this is an interesting stock. It's been a stock that if we look back on a longer term basis, right, we look back at a 3-year weekly chart, we can see that it has been extremely higher than it is now. And if we look back on, say, for instance, let's change that time frame back out to, say, for instance, a 10-year chart, and we go back to that really extreme. I mean, it was up at 240. And that wasn't that long ago. That was 2019, so just before the pandemic. Beyond Meat was everything, right? Everybody wanted Beyond Meat because it was the savior of fast food. It was the savior of the agriculture industry and so forth. And so that being the case, look at what's happened to it, right? Beyond Meat has now made this move. So I want to put this into context, and that context is important here. This is a stock that has been significantly higher. Now, looking down here, and you guys that are saying, hey, this is and then they tasted it, Kevin. I love that. Yeah, and then they actually tasted it. I don't know. I've had a couple of those. I had a Beyond Whopper probably back in mid 1919 or 2019, not 1919. That would have been really weird because I wasn't born there yet. But in 2019, I had a Beyond Whopper, and it was probably okay, I think, but didn't necessarily live up to the promise. Now, let's come back down to our regular time frame here. This is 1-year daily chart, and you can see this big move to the upside. In fact, it went from sub $1. It was 49 cents. And look, I'm using this as an illustrative example. Again, not a recommendation of the symbol at all. But the move that it made on very likely a short squeeze, very likely a meme stock-like push, that short squeeze being there is a lot of shorting. Those shorts are forced to cover as price begins to move. And you can see some of the hallmarks of that short covering squeeze here where you get these gaps to the upside. And then it moves up very quickly. And then everybody that was in the trade and holding on to this and saying, hey, you know what? The next time this makes a move, I'm going to sell that sucker and I'm going to get out and salvage something. And that's where you get these big pops to the upside and then these moves back down. So if we were to take a look and I were to look from this low to this high, just drawing that's 1,400%. That's a 1,400% move. That's a big move. That's an extreme move. So I wanted to put this into context. This was the inspiration for this discussion, but it's a useful inspiration because it gives us the ability or the idea about kind of plotting what those extremes are, what those extremes mean, and taking advantage perhaps of those extremes, especially if we are, say, for instance, in a position to fade the rally or buy the dip. Those are kind of the actionable points in this. Fading the rally, meaning selling against that upward movement or taking some profit in the trade. Buying the dip when it makes an extreme move to the downside, stepping in and entering a position long, given the fact that the thought is that it would continue to move to the upside. So while this is maybe more short-term in nature, it is not necessarily an intraday strategy, although it can be used on an intraday basis. Neither is it necessarily a long-term investment strategy. Now, speaking of long-term, we are invested in these webcasts for the long haul, and we want to make them better. I just happened to notice, and Barb will repost this in the chat, that we've got a feedback survey in the chat. So help us to make these webcasts better in the long run by filling out that feedback survey and giving us what you think. It's 2 questions and an open field for your comments. And we read every single one of your comments. We love seeing your scores as well. So this made this big move. Now, I want to do this really quickly because I want to get into the particular technical study. And we're not just going to go into the breakdown of a particular technical study and say, this is what this study does, and this is how you use it and how it can be. Okay, I want to kind of put this into this context, right? When you see these extremes, we get a little bit kind of, it runs into our trading psychology, and we think, wow, that's something I can do something with, but let's temper it with how extreme is extreme. So what I've got set up on here is a study set. I'm going to come up here to my flask icon up at the top of the page. And I've got 3 different Bollinger Band studies. And you think, oh, Bollinger Bands, those are boring bands, not Bollinger Bands. And probably to a lot of traders, that may be the case, that Bollinger Bands tend to be a little bit boring in nature. I mean, they're, I don't know, maybe not, but they're generally a representation of volatility. When volatility is low and things are boring, the Bollinger Bands get close together. And when volatility is high and the Bollinger Bands are far apart, maybe things are a little bit more exciting. But now we're going to turn it into extreme Bollinger Bands. We'll sell you the whole seat, but you're only going to need the edge today. Now, here's what we're going to do. We're going to take that first expression of Bollinger Bands, the default Bollinger Bands. And the default to the Bollinger Band is a 20-period moving average. It is a 20-period simple moving average. And it is a line plotted at 2 standard deviations above and 2 standard deviations below the level of that 20-period moving average. So it smooths out the price movement, first of all, and then it takes those extremes, in this case, 2 standard deviations. You think about what 2 standard deviations incorporates, and that incorporates about 99%, almost 99% of the moves. So we're gonna talk about what those significant outliers might very well be. Now, Chuck asks a great question here. Is it better to get confirmation from multiple studies, not overdone, meaning not, I don't need confirmation from 10 studies instead of just one and on multiple timeframes? And I would argue this, as long as you keep it reasonable, right? Not overdone. I wouldn't go more than, maybe, and many technicians will suggest this, I wouldn't go more than 3 technical studies to try to get confirmation, because you're always going to kind of have that minority report. And which one do you listen to? So maybe 2 studies, or maybe trend direction and 2 studies. I mean, whatever you want to do, that's fine. But keep it relatively simple. Don't get over. A lot of times we as traders tend to get kind of out of control when it comes to technical studies, and we start to add all kinds of different technical studies. If you've got 5 technical studies on your chart, I challenge you to articulate in 1 sentence the signal that that chart is giving you, because I'll bet you can't do it. So we're going to take the typical default Bollinger Band. That is 20-period moving average, 2 standard deviations. And I'm going to put it on the chart. I'm just going to open up the eyeball here, and I'm going to click on apply and OK. And there is our standard, normal, typical Bollinger Band study on this particular chart. Kind of cruising along, and we see that as, oh, you know what else I'm going to put on this chart really quick? I'm going to put implied volatility. Implied volatility not necessarily is an expression of a reflection of what we might do with options, but implied volatility is a reflection of what kind of the expectation is for the market and for the stock. And these two aren't going to be actually directly correlated, but they are pretty close. So we're going to click on apply and OK. And you notice that implied volatility down here. Now, look, I mean, this is a relatively small price stock. I mean, we're talking about a $1 price stock here, and that implied volatility was running kind of relatively low anyway. Now, we could argue that it was boring. Then when implied volatility begins to increase, when there's maybe a little bit more speculation, now we start to see those Bollinger Bands widening out a little bit. And as they start to widen out a little bit, that gets us to that point of saying, hey, maybe something's going on. Because just like implied volatility tends to be mean reverting, if it's low, it tends to rise, and if it's high, it tends to fall. Bollinger Bands, as an expression of volatility, tend to be mean reverting as well. When they squeeze together, they tend to pop apart. And when they pop apart like that, they tend to then come back together. Volatility extremes don't tend to last for a long period of time. They don't tend to move that way. A couple of other tendencies about price and reflection of the Bollinger Bands is the fact that when the price is trending, it tends to walk along one of these two Bollinger Bands, if it's trending up, it tends to walk along that 2 standard deviation Bollinger Band. And when it's trending down, it tends to walk along the bottom 2 standard deviation Bollinger Band. It's that idea, see, of mean reversion for sure. But when we get these extremes, then we go, wait a second, this just kind of blew those Bollinger Bands way the heck out of the water. And now it's come right back in. So the question is, what's the level of extremeness? How extreme is extreme? Listen, I just want to kind of say this. I love sour candy, and I love really extremely sour stuff. The more sour the candy, the better. I don't know that I've found one that is too sour. But marketing being marketing, right? Marketing being marketing is, they tend to say extreme and not really mean extreme. I want extreme. I want to know what extreme is. So are we at an extreme level here when it goes to 2 standard deviations, even if those 2 standard deviations have moved? Yeah, not really. Because it can still move further. But when it moves further, there is a tendency for it to mean revert quickly. Now, Zinc asks a couple of questions. You ever heard of Keltner channels? Keltner channels, I love it, Will. Great. Sour Skittles, you bet. Keltner channels are based on, based directly on implied volatility. Bollinger Bands generally on historical volatility, but Keltner channels directly based on implied volatility as a function of where those bands are. So they're going to be close to Bollinger Bands. Yeah. Now, Rita asks a question. Looking back, how would I have a chance, or how would I have set this trade up to take advantage of this? And I'm going to show that here in just a second. So what I'm going to do, if this is 1 standard or 2 standard deviations, this is the typical Bollinger Band, we know that price went beyond that range. And so going beyond that typical range suggests something that I could take action with. So if I had been watching this and I said, hey, you know what? If I'm right here on the cusp of this moving, it's right up against that 2 standard deviation Bollinger and moving up, I'm going to look. So Rita, this gets back to your question. I'm going to look for an opportunity perhaps to trade this in the opposite direction that it's going into that extreme Bollinger, right? So if it breaks out of that Bollinger Band, it closes outside of the Bollinger Band range, I'm going to look to fade that rally or sell against that rally. But then it does something like this, and you go, oh man, is that really beyond? I mean, is that really extreme? So CI says, look for that crossover. Yeah, looking for that crossover from below to above that Bollinger Band, or from above to below the lower Bollinger Band. That can be kind of that trigger to set up for that setup that might be actionable. But now we get this big move to the outside. So now what I want to do is I want to make this a little bit extreme. I'm going to go up here to my flask icon again. And I said, all right, if this went to 2 standard deviations, which is 2 times, that's about 98% or 99% of the typical moves that the stock makes. So anything outside 2 standard deviations is really going to be a statistical outlier. Did it go 4 standard deviations? Did it go twice that range, that out to 4 standard deviations? So I'm going to turn on my 4 standard deviation Bollinger Band. And all I did to get this is I left the length the same. I left the 20 period length the same. So I'm not getting weird changes in terms of the duration of the Bollinger Bands. But I went out to 2 standard deviations beyond the typical. So I made this 4 standard deviations up and 4 standard deviations down. And I changed the color of this line. I'm going to make that a little bit heavier so that we can see it. And I'm going to click on OK. And we're going to turn the eyeball here on and apply an OK. And so now this line right here, that yellow line, is 4 standard deviations. I mean, that incorporates like 99.95% of all of the price returns. So anything that gets out to this level, and is way out here in that extreme, that's something special. That's really made a big move. But could we get more extreme? Could we get more sour? Give me more sour, more extreme. So I actually also created on this chart, in this study set, 6 standard deviations, a super duper extreme double dog dare you Bollinger Band at 6 standard deviations. And again, same thing. I made that kind of a dotted line here so that I can see where that extreme was. I just kept the length the same, and I went to 6 standard deviations up and 6 standard deviations down. And I click OK. And I'm going to turn this one on, and I click on apply and OK. And yeah, holy sick. Okay, so zinc. Zinc got it. Zinc is the mystery word of the day winner. Barb Armstrong owes you $5. Just kidding. But zinc is the mystery word of the day, 6 Sigma. And if you're familiar with 6 Sigma, and I don't by any means profess to be a 6 Sigma expert, but 6 Sigma is a quality control measure looking at trying to eliminate all of the potential outliers in a process, right? So as we get to this, okay, we're going to get there, Go Tribe. Hang tight. We got to talk through the process first, and then we'll get to how do we use it, okay? So look at what happened to price. Price went out to that 6 standard deviation level. And you say, well, wait a second. How often does that happen? How often does a price make a move out to 6 Sigma, 6 standard deviations, and does it ever stay there? So we can come back and we can, yeah, I'm not giving you my shirt, Barb, but you can come back and we can look at this in hindsight and we can say, look, there were times where this touched that 6 standard deviation line. And then what did it do? Well, first of all, volatility then expanded very quickly. But second, it followed almost invariably. Then when we got a touch of that 6 Sigma line, the price went the other direction. Now, it didn't do it immediately. And if we go back and we'll just zoom out of our chart here, we see that every time, and we haven't had that for a while, but every time that price kind of got out towards that 6 Sigma line or 6 standard deviation line, or maybe even the other way to think about it is whenever price closed outside the 4 standard deviation Bollinger Band or at the 4 standard deviation Bollinger Band, price went the other direction. Now, this is just one example. There are others, but this gives us an opportunity perhaps to say, look, if I had a crossover alert and I see price going above that level, I'm going to look at trading it potentially in the opposite direction. So if it were to move down to 6 standard deviations, I'm going to trade it in the opposite direction. So that's kind of what we're using this particular tool set for. And this is 3 different Bollinger Bands, 2 standard deviations, 4 standard deviations, 6 standard deviations, and I've got implied volatility on there as well. So here's what I'm going to do. I'm going to click on OK. I'm going to come over here to this grid, and I'm going to share this grid for you. I'm going to save this, first of all, and I'm going to share this grid with you so that you can use it. And by the way, I'll put this in the description for today's webcast for those of you that are watching the recorded version. But anytime we share something, remember that that's for illustrative and educational purposes only. And it is for, it is not guaranteed as to time or accuracy, but I'm happy to give it to you. So if we were to take a look at some other instrument, right? If we were to take a look at, say, for instance, let's zoom back out and look at this 1-year time frame. Let's take something that is in the news as perhaps a volatile stock, but has been driving in a particular direction. Let's see if NVIDIA, for instance, ever gets out to that 6 Sigma range, even though its implied volatility moves up and down and the price, it never really gets out to that extreme. So there's probably a lesson that we could learn from this. Lower volume stocks that have more volatility historically may reach these 6 Sigma numbers or that extreme Bollinger Band ratio to a greater degree. Stocks that trade with lots and lots of volume, maybe not so much, because it becomes harder because of all of that liquidity to push price to extremes, because those pushes get arbitraged very, very quickly. So if we were to look at something else that's made big moves, for instance, recently, and that is, say, for instance, gold. And we're using the gold futures here as a measure of the market, not a tradable instrument. But if you are going to trade futures, recognize that futures are carry with them a significant amount of risk. They're not suitable for all investors. They require separate trading authorization. If you're going to trade a futures product, make sure that you understand and have read all of the considerations for trading futures, and remember that it takes separate trading authorization. But take a look at even at these moves in gold, for instance, and they're just kind of staying within that typical range here. They're staying just about at that 2 standard deviation, even as volatile as they have become. Let's take a look at something like Tesla, TSLA, which could be a volatile stock, but tends to stay within that range. And again, liquidity equals perhaps some dampened effect here. Netflix, NFLX, we'll just kind of roll through some of these. And it gets out past that 2 standard deviation a couple of times, but it never really even gets out to that 4 standard deviation. So this hopefully, I think, will scratch the itch, maybe of those of you that are looking for these extreme moves. Let's take a look at GME, GameStop. And this is one that has been one of those meme stocks. And you can see that even there, that has gotten out to that 4 standard deviation range a couple of times and moved the opposite direction, but never really moved out to that 6 sigma range. And you can see again that tendency of Bollinger Bands once they expand to then contract, expand, and then contract and squeeze. Others in this space, RGTI, thanks for bringing that one up. So not a lot of Bollinger Band expansion here, a lot of going sideways, and then all of a sudden it moves. So what this demonstrates is that big news-driven moves are going to take you out potentially to those ranges, but trending stocks typically aren't going to push the outside extremes of this Bollinger. So this could be a good kind of filter. Is this big move a big move that's news-driven, or is this part of a trend that's been happening? So that's kind of an element of this. Now, what I did is I said, all right, fine. And Rita, your thought process was exactly the same as mine, I'm guessing, here in this particular case, and thinking, you know what? How do I go about finding these scenarios? Now, my first thought was I could come up here and I could create a watch list, and I could say, all right, let's take the top 10% gain so this is a publicly available watch list in my top 10s, top 10 gain in the NYSE. That's going to go top 10 gain in the NASDAQ, right? Some of these more volatile. And so I've got net change here for today. And these are stocks that have moved a significant amount today, right? This is the top 10 list of movers today. That's gains. Now we'll look at losses here in just a second. But here's the one that's got the biggest gain so far today, 27%, or excuse me, plus $27 in this particular case. So that's a pretty big move. Implied volatility really hasn't started to follow along yet. That may come. So in Hibrix Biosciences, I don't know anything about the stock, but here's where that filter can say, oh, this is pretty extreme. This move to that 6 sigma, because it's out there. It's not quite touching it because it expanded pretty quickly, but it's above the 4 standard deviation line, and it's currently sitting between 4 and 6. So could this be an opportunity to fade that rally? And if it were to go the other direction, could that be an opportunity to buy the dip? So some traders might be looking at this and then saying, okay, this is out at that extreme. I know that when stock prices get pushed to an extreme, they very rarely, if ever, stay out at those extremes for a long period of time. And more often than not, this indicates a reversal position. So that would suggest that this was maybe, guessing from the type of stock that it is, that maybe this was an FDA approval or lack thereof if the government shut down. I love it, Bruce. Contrarians at the gate. You're absolutely right. That is kind of maybe that's what I'll title this particular webcast, is Contrarians at the Gate. I like that. But looking for that fade the gap type of approach here. Now, again, not a recommendation, but simply a use of a technical study just in a couple of different ways to take advantage of that circumstance. So let's take the other side of this coin, because I think this becomes a little simpler in terms of demonstration. So let's go to the Market Watch tab and let's change this from top 10 net gainers in the NASDAQ to top 10 losers in the NASDAQ. And you say, well, why do I want losers? Because I want to see if there's a buy the dip possibility here, given that extreme Bollinger Band move. So let's sort this again by net change. And we've got Kinsale Cap Group. Again, don't know anything about it. It doesn't trade with a lot of volume. I'm actually going to go to this one, VeriSign, because it's got a little bit more volume. So I'm going to look for that one. We'll go to the other one too, but I'm going to go first to VeriSign, and I'm going to go to the chart. And I'm going to say, where did this go? It touched down near that 4 standard deviation. Not really extreme. Not really extreme. Kind of extreme. Maybe sort of milquetoast extreme. Let's go back to that other one. Let's go to Kinsale. And I don't know anything about it. Not extreme at all. Man, that's a little bit disappointing. That has a tendency to be a little bit more volatile, so that's not getting out to that extreme. And volatility expanded because it's just after an earnings announcement, so it didn't really do much. Let's see if we've got anything else in this list that might be moving. Well, we already looked at Tesla. Let's look at Deckers Outdoor, which has made a 12% or a $12 move to the downside. And look at what that's doing. You come over here, and this is where that squeeze and pop function may give us some idea. So look at this. We've got fairly narrow implied volatility, and a lot of that has the fact that it just came off of an earnings announcement. But on that earnings announcement, and you know what I'm going to do is I'm going to shift this up a little bit, just kind of squish this around so that we can see it a little bit better. It's touching that 4 standard deviation extreme. So not super duper double dog dare you extreme. It's not at the 6 sigma, but boy, it hit that 4 standard deviation line and it's starting to come back up. So a trader looking at this as the possibility of selecting a buy the dip scenario coming off of that earnings announcement with that gap down and rally might say, hey, this is my trigger. It touches the 4 standard deviation line, that extreme Bollinger, not the extreme Bollinger. I'm going to use that as an entry signal into a short-term trade and trade it back either to the mean, kind of that midpoint, or maybe out to that next level of that 2 standard deviation Bollinger. So I'm going to come in here and I'm going to step in and I'm going to right click and I'm going to buy this. And I'm going to buy this with a OCO bracket. And the reason I'm going to buy it with an OCO bracket is because this now gives us the Bollinger Band in this extent, gives us some definitions for where we could get out of the trade and where we could get out of the trade if it's going in our direction, in the direction we want it to go. So I'm going to look at getting into this trade. And again, this is a short-term example, and this might not be the best example, but it is an illustrative example. So I'm going to look at my target being up here at that typical Bollinger Band up at the top. And I might look at getting out of this trade at 106. So I'm going to put my limit in here, my sell limit at 106, which says sell this stock at that price or higher. So if it gaps up, cool, that's great. I can get out at that price. And I'm going to make that good till canceled. If it goes down, I want to get out at that really extreme level. I can use this extreme level. The likelihood of it getting down there to that 6 sigma line in this particular case, to the 8051 is pretty low. But that also suggests that if it does get to that level and I do get kicked out, I'm getting kicked out for a darn good reason. So I'm going to look at this and I'm going to get out on that 80. Where is my 6 sigma line? It's at 8090. So I'm going to call that 81. And I'm going to round. Yeah, I know the problem with rounding on stops, but I'm going to make that a stop at 81. Remember, that doesn't guarantee the price that this gets filled. It just specifies where that order would be triggered. Doesn't guarantee where it's going to get activated. Yeah, and you're right, Chris. You could put it at today's low plus 2% or minus 2%. Absolutely. So I'm going to click on confirm and send, and we're going to fire this order off. I'm going to give it a little bit. It's at 90.19. I'm going to give it a little bit because I want to get into this trade, and I'm going to make that still back to 0. And we'll click on confirm and send, and I'm going to put this in my market movers group so that I can keep track of it. We're going to go ahead and read the order, make sure that's what I want it to do, make sure I'm aware of any alerts, and we're going to click on that entry, and we'll see if we can get into this long. And it's already started to move on us. We got to bump this sucker to get in. I'm going to come back here to my working orders. I'm going to right click and cancel replace. And I'm going to bump that up to, I'm going to open up that to 90.28. We're going to go ahead and put that in market movers. And we got in at 90.26. And we've got that, that OCO bracket in there. By the way, speaking of brackets, we've got that survey down there in the chat. Barb's reposted that there as well. Do me a favor, fill that out. Let us know what you think. Now that we've done an example of this trade, I kind of came at this from the back end. I found a watch list, and I just went through the list. But what if we were to create our own watch list that looks for those circumstances? So I'm going to go to my scan tab, and I'm just going to reset this really quick. And what I did in this case is I just did a couple of things. I went to scan in all stocks, and I went to my public watch list for the S&P 500. So I've already narrowed it down to 500 stocks. And then what I've done is I did the intersection, kind of a Venn diagram, with those stocks that have weekly options. It doesn't mean that I'm going to trade weekly options. It doesn't mean anything else other than those are likely the ones that have some option liquidity. Okay. And now I'm going to just filter this based on volume. And the reason I'm filtering this on volume is because I want a liquid stock. I don't necessarily want penny stocks. I could leave this at a volume number that is less than that. Okay. But now if I were to just keep this scan right here and run this scan, I've got 170 stocks that kind of fall within that characteristic. But I'm going to add another filter, and I'm just going to add a simple filter here. It is a study filter. Now, this is where Paper Money falls short of the live platform, because Paper Money isn't going to let you build these or use studies in those scans. But this is where, again, this becomes something that you know about and you can use. So what I'm going to do is I'm going to choose in this study list, I'm going to choose a Bollinger Band crossover. So I'm going to make this pretty simple. I'm going to look for circumstances where price closes, and I could change this and edit this to be trades, but I'm going to use close below the lower 20 period moving average for standard deviation Bollinger Band using the simple moving average. And I'm going to go ahead now and run that scan again and see if I get any results of stocks that have met these particular characteristics. And I don't. So you know what I've got to do? I got to come back in here and I've got to edit this a little bit, because okay. All right, I think I'm back. I think I know where I am, because Barb caught it. I need to come back and edit this a little bit. Okay. Are we back? I think we're back. Excellent. Okay, we're going. We're rocking and rolling here. There we go. Okay, good. So I said, I think we need to edit this a little bit. And what I did is I took it from 4 standard deviations and I edited it down to 3 standard deviations. And so I went to 3, halfway in between, and I ran the scan again, and I got exactly one result out of this list, and that was that Deckers Outdoor that closed at 3 standard deviations down and gave me that opportunity to take that trade to the upside. Now, if I wanted to be a little bit less restrictive, I can clear that filter and we can run this scan and see if we get anything else. And there's VeriSign that made that move to the downside. Let's take a look at that one as a result. That is scan VRSN. We'll come back over here, VRSN. And look at that. That closed right down there. And that's where it is at the moment, closing outside that range and the possibility of this turning around. Now, is there the possibility it'll keep going down? Yeah. But it might bounce and go up. And again, when we see those Bollinger extremes, that often signals a reversal. And if we can find those extremes, that can give us an opportunity to take action on either a fade to the rally or buy the dip scenario. So you know what I'm going to do? I'm going to come back over here to my scan tab, and I'm going to say, let's do this. Let's save this scan as extreme Bollinger scan 3 STD. And I'm going to go ahead and I'm going to save that. And then I can come back and I can have a dynamic watch list with that. But you know what I'm going to do? Because I like you guys, I'm going to go ahead and I'm going to share this with you. And remember, anytime I share a scan, it is not a guarantee, right? And yeah, and Rita, good point. You could sell a put below that. You could look for several reversal bounce and then act. Absolutely. Now, which filter did I use did I eliminate to get VeriSign? I took out the weekly intersection. All right, guys, a lot of fun stuff here. This is a great, class to kind of experiment with these things. Is there one guaranteed way to do things? Is there one best way to do things? Absolutely not. Is there one best technical indicator? Absolutely not. But have some fun with it. Play around and experiment and see what you think, and look for some of these ideas. And it's always fun to do stuff like this on a Friday and enjoy this, and do something like this and see what you find. Is this a way to trade all the time? Maybe not so much, but sometimes you guys want to find those stocks that are making those big moves, and this is a way to find those big moves. So let's do this. I just want to quickly remind everybody that you've got access to this phenomenal resource right here. So if you want to come in and you want to type in Bollinger in the Trader Talks webcast page, there you go. There's Brent Morris teaching that. There's Bollinger Band Bonanza, trading with Bollinger Bands, beginner's guide to Bollinger Bands, ways to trade Bollinger Bands, trading Bollinger Bands, all kinds of Bollinger Band. I mean, more Bollinger Bands than you can bat your eyes at here on the Trader Talks webcast page. Click on subscribe while you're there. My great thanks to Barb Armstrong for helping me out today, and for Andrew and Gabe for getting us back online again. Thanks for having a great extreme day. Guys, let's have a great afternoon. Kevin Horner is going to be teaching market, or actually what it was Market Movers, what is now market and sector analysis, coming up a little bit later today. And wait, hold on. I don't want to go yet. Stand by. Don't leave. Don't leave. Come right over here to the Schwab coaching page, schwab.com/coaching. And if you come over here to our in-person events page, coming up in Miami, I just wanted to tell this, and this is Kevin and a few other people that had asked me about this. Our Miami event is coming up in December. Beautiful, beautiful place to be in December ahead of Christmas. But we're doing an advanced option strategies workshop live and in person. The reason I'm excited about this, a couple of weeks before, we're going to be in Houston with Barb's going to be there doing technical analysis and option strategy. She's going to be in Miami as well. But right here in the Miami workshop, we've got an opportunity. Click on Learn More and click right down here to View Agenda. And if you click on View Agenda, this will pop up theoretically. Come on. There it is, right there. We have an opportunity here, and this is not typical, but this is an opportunity here in the Miami event. We've got a discounted room block at the JW Marriott Turnberry, which is so beautiful. We'd love to have you be there with us. That's how you get that discounted hotel rate. There are limited rooms available. There are limited seats in this workshop. So come and get registered now, and let's get it filled up. But join us there. We'd love to have you at any of our live events. Again, my thanks to Barbara Armstrong for helping out, and to all of you guys. And I'm glad that we were able to show that and do that. Have a great Friday and great weekend, everybody. We'll see you soon. Take care. Bye-bye.